The highest court in the United States of America walked into the precious metals market this morning with a gavel. 9 justices, 1 ruling. And for exactly 47 minutes, it looked like they had handed the bullion banks the most powerful weapon they had ever been given in a single session. The price of silver did not ease lower. It did not drift politely into the red on thin volume. It did not give bulls time to breathe or think or reposition. It fell off a cliff. A coordinated wall of paper selling crashed the spot price from near $80 all the way down to $79.80 in the span of minutes, so few that most retail investors did not even register what had happened before it was already over. The most powerful judicial institution on this planet had just handed the bullion banks what looked like a perfectly legal, perfectly timed, perfectly calibrated instrument of destruction, and they fired it without a single moment of hesitation. For those 47 minutes, every silver bull on this planet was holding their breath. Some of them sold, some of them panicked. Some of them looked at that chart cracking lower with velocity and concluded the rally was done, that the top was in, that the intelligent move was to liquidate before the damage compounded further. They were wrong. What happened next is the entire reason this broadcast exists today. The silver market did not stay down. It did not find a base and drift sideways into a quiet Friday afternoon close. It reversed, violently, completely, and with a force that has left every institution on the wrong side of the trade staring at their screens in silence. It staged one of the most ferocious single-session recoveries in recent memory. It erased every single cent of the manufactured decline, and then it kept going. By the time the dust settled, silver had not merely recovered from the attack. It had ripped clean through $84, a swing of more than $4 full dollars from the absolute low of the session. All of that compressed into a single chaotic Friday morning in February 2026. And here is what every mainstream financial outlet is ignoring right now. That reversal was not random. It was not a technical bounce. It was not algorithmic noise. It was a declaration. The physical market sent its message in the only language that actually matters in a commodity market: price. $77.39 was the low. $84.52 was the close. Silver closed today at $84.52 per ounce on the bid, a gain of $6.10 in a single session, a move of 7.77% in one trading day. Gold closed at $5,115.90 per ounce, up $110.70, a gain of 2.22%. Gold also spent the entire session well above the $5,100 level that mainstream technical analysts had been publishing as an impenetrable resistance ceiling as recently as this week. But the raw closing numbers, as significant as they are, do not tell the actual story. The story is in the route those prices traveled to get there. Silver's session low was $77.39. Silver's close was $84.52. That is a range of more than $7 from the bottom of the session to the close. That is not a day of normal price discovery. That is a war compressed into a few hours of trading. A test of which force in this market is actually dominant: the paper algorithms executing macro keyword logic in milliseconds, or the physical buyers who look at the global situation and make a calculated, size-weighted decision about what this metal is worth right now. The physical buyers won today by a margin that should deeply concern every institution that was sitting on the wrong side of that trade. To understand why the trap that was set this morning failed so completely, we need to go to Washington, D.C. We need to talk about the ruling that came down from the Supreme Court and how the entities that run the paper futures market tried to use it as a precision weapon against the silver price. This morning, the Supreme Court of the United States issued a 6-3 decision striking down the current administration's broad tariff program as implemented under the International Emergency Economic Powers Act. It was a significant ruling. The legal and policy implications of that decision will be debated in law schools and congressional hearing rooms for a long time, but none of that is why it matters for this broadcast. What matters is the specific way in which the high-frequency trading algorithms that execute the majority of the paper volume in the precious metals, futures markets, are programmed to process a headline of exactly that category. These are not analysts deliberating over implications. These are not portfolio managers picking up the phone to discuss strategy. These are machines scanning live newswire feeds for specific keyword combinations and executing predetermined binary trading logic at speeds measured in microseconds. The programming structure is essentially this: the presence of tariffs signals inflationary pressure on supply chains and hard assets, bid them up. The removal of tariffs signals the opposite: sell hard assets. The millisecond that ruling hit the institutional terminals, the machines executed. No deliberation, no contextual analysis, no assessment of any concurrent variables. A coordinated dump of paper silver futures contracts hit the market with a volume and velocity that was specifically designed to overwhelm the existing bid stack. The spot price cracked from near $80 down to $79.80 almost instantaneously. For a retail investor watching that unfold in real time, it looked exactly like a momentum breakdown. It was designed to look like one. The entire intent was to trigger a secondary wave of retail panic selling. If enough investors see the price drop 8% in minutes on an apparently coherent macro catalyst, a significant percentage of them will sell. And when they sell, they hand their positions to the very entities that manufactured the crash, at the exact price those entities wanted to acquire them. This is a wealth transfer mechanism wearing the costume of a legitimate market reaction. But the mechanism broke this morning. And it broke because while the algorithms were executing their deflationary keyword logic, a completely different set of market participants was processing a completely different picture entirely. The sovereign wealth funds, the industrial procurement managers, the physical metal dealers with direct access to the underlying order book. None of them were looking at the tariff ruling. They were looking at a Persian Gulf that was 48 hours away from a weekend that no entity with a significant short position wanted to own. They looked at silver, sitting at $79.80, and saw not a warning signal, not a momentum breakdown, not a reason to reduce exposure. They saw a clearance price for an asset they already needed to own before Monday morning opened. The physical demand that materialized against that dip was not cautious. It was not measured or hesitant. It was immediate, concentrated, and aggressive. The paper algorithms had accidentally constructed a discount that serious institutional buyers treated as a formal invitation to accumulate at scale. The bid stack rebuilt itself faster than the machines could reload their sell orders. Silver reversed. The lows were never retested. The close was $4 full above the level where the trap was originally sprung. The entities that built that trap are now sitting inside it. They entered this Friday carrying significant short exposure. They deployed their most aggressive suppression instrument of the session, and the market closed $4 above where they fired it. That is not a neutral outcome. That is a position that is bleeding at a rate that becomes exponentially more dangerous with every hour that passes between now and Monday's open. Now consider the broader architecture of why this specific Friday was the worst possible day for that trade to fail. When you are a major financial institution holding significant short exposure to gold and silver through futures contracts, the open market is your operational oxygen. Every minute the market is trading, you retain the ability to cover, hedge, rebalance, and manage your margin requirements. You have options. You have flexibility. You can respond to changing conditions in real time. But when the closing bell rings on a Friday afternoon, that capability is suspended entirely. The market freezes for 48 hours. You're locked into your existing position with zero ability to respond to anything that happens in the world between Friday close and Sunday evening when the Asian session begins. If a geopolitical event fires over the weekend and the Asian markets gap violently higher on Sunday night, you are not managing a loss. You're responding to instantaneous margin calls across your entire portfolio simultaneously. In a worst-case scenario, a single weekend destroys you. And the entities holding those short positions right now are walking into what may be the most operationally dangerous 48-hour window any institution in this market has faced in recent memory. Now look at what this specific weekend actually looks like from inside an institutional risk management department. Because this is not a hypothetical stress scenario. This is not a theoretical weekend risk discussion. This is the live operational reality that every entity carrying a naked short position in precious metals is staring at right now as the Friday close locks them into their books. The United States military has repositioned naval assets in the Middle East at a scale that has not been observable in decades. Carrier strike groups are operationally placed. The language emerging from Washington has crossed the threshold from diplomatic signaling into what analysts who professionally track these things describe as the rhetoric of operational readiness regarding Iran. And the geography of this specific confrontation is what is sending the real signal through every serious institutional risk management department on the planet right now. The Strait of Hormuz is 21 miles wide at its narrowest navigable point. Through that 21-mile gap moves approximately 20% of the world's entire daily energy consumption. 20 million barrels of crude oil and liquefied natural gas transit that waterway every single day. Iranian asymmetric military doctrine has centered for decades on the capacity to close that corridor through the combination of shore-based missile batteries, naval mining operations, and coordinated attacks on tanker traffic. A kinetic engagement in that geography does not produce a gradual increase in oil prices. It does not give markets time to adjust or hedge or rotate. It produces a vertical spike to levels that would make the post-pandemic inflationary period look mild by comparison. And the scenario becomes exponentially more complex when you factor in Iran's full alliance architecture. This is not a bilateral confrontation between two isolated parties. Iran is a formalized member of the BRICS bloc with deep, mutually obligating strategic relationships with both Russia and China. Senior traders in London and New York are invoking a specific historical reference to frame the systemic risk they are currently pricing. The Archduke Ferdinand scenario from 1914. The assassination of one man in Sarajevo activated a cascade of formal alliance obligations that pulled the entire planet into a war that no individual party had fully intended, and none could contain once it began. A strike on Iranian infrastructure today carries that same chain reaction risk. A localized action triggering escalating responses that no individual party intended and none can fully contain. This is the risk that institutional money is now pricing as a non-trivial weekend probability. And the pricing mechanism for that fear is gold at $515.90 per ounce. Gold did not drift higher today on a quiet Friday afternoon. It went vertical. It sliced through resistance levels that had been published as impenetrable in mainstream technical analysis reports as recently as this week. When gold moves with that kind of velocity and that kind of conviction, it is not being driven by retail investors. It is being driven by sovereign wealth fund allocation shifts, central bank reserve adjustments, and institutional family offices making rapid decisions to reduce paper exposure and increase physical weight in their portfolios. They are not making a trade. They are making an insurance decision. And they made it today because they are not willing to hold the alternative through a weekend that carries this profile of systemic risk. But the buying pressure that moved markets today is only half of the equation that is building in this market right now. The second half has not arrived yet. And when it does, it will hit a market that has almost nothing left to absorb it with. For the past week, the single most consequential buyer of physical silver in the global market has been sitting at the table in name only and physically absent entirely. China has been observing the Lunar New Year holiday. The Shanghai Gold Exchange and the Shanghai Futures Exchange have both been closed. The state-affiliated industrial procurement networks, the manufacturing supply chain managers, the sovereign reserve accumulation desks, all of them have been offline and completely out of the market. The Western banking cartel was fully aware of this window. They used the reduced Eastern liquidity as the operational foundation for their holiday suppression campaign. The strategic objective was clear: drive the paper price lower in the absence of the market's most aggressive physical buyer force, trigger stop losses from retail and speculative accounts, and reset the chart to a technically weaker picture before the Chinese market reopened and the real structural buying resumed. They partially executed the volatility. They entirely failed the objective. Silver without China sitting at the table absorbed the full SCOTUS algorithmic slam and closed the session at $84.52, up 7.7%. On the day the banks threw everything they had at it, with China completely absent from the equation. Now consider what happens when China sits back down at the table on Monday morning. Chinese demand for physical silver is not speculative in nature. It is not driven by sentiment or momentum or macro positioning. It is driven by a national industrial strategy that is structurally dependent on physical delivery of this specific metal without interruption. China manufactures the overwhelming majority of the world's solar panel capacity. It produces a dominant share of global electric vehicle output. Both of those supply chains require physical silver in quantities for which there is no commercially viable substitution at any price level. That demand does not compress during a geopolitical crisis. It escalates because silver is simultaneously a critical strategic military material. Advanced missile guidance platforms, phased array radar systems, and hardened satellite communications infrastructure all require ultra-high purity silver. When a country is watching its formalized strategic partner face the potential of kinetic military action by the world's largest naval power, it does not approach the global silver market as a speculative opportunity. It approaches it as a strategic resupply window that may be closing faster than anyone anticipated. The buying that Chinese institutional entities are going to execute when those markets open is not going to be patient limit order accumulation. It is going to be aggressive, price-insensitive demand for every available physical ounce that can be sourced from Western vault systems before the window compresses any further. And this is precisely when the second structural pressure in this market arrives at exactly the same intersection. The end-of-month delivery window is approaching in New York, and what is sitting inside that delivery window right now is a problem that the entities holding short positions cannot solve with algorithms, cannot defer with keyword logic, and cannot escape with paper settlements if the counterparties on the other side decide they want the metal. The entities holding long futures contracts will be issued delivery notices requiring them to make a decision. Accept physical delivery of the underlying metal, roll their positions into the next contract month, or accept a cash settlement in lieu of actual delivery. In a normal market environment, a significant percentage of long holders roll or settle in cash without conflict. It is routine. It is expected. It is how the paper market has functioned for decades without facing its fundamental structural contradiction. But we are not in a normal market environment. Not even close. The registered inventory available to settle delivery obligations in New York has been systematically drained to levels that are historically anomalous. The ratio of outstanding paper claims to physically committed deliverable ounces has reached a point of mathematical brittleness that no serious analyst who has looked at the actual registered vault numbers can describe as comfortable or sustainable. If the geopolitical panic that is currently building over this weekend drives even a modest additional percentage of long holders to demand physical delivery rather than accepting paper alternatives, and if Chinese institutional demand simultaneously removes meaningful tonnage from the available Western vault inventory when those markets reopen Monday morning, the arithmetic of what remains in registered COMEX storage against what is owed becomes a number that this market has never been forced to actually confront in real time. This is not a theoretical future risk. This is a pressure that arrives at the delivery desk within days, not weeks, not months, days. And the entities sitting on the short side of this trade right now are fully aware of every single one of these variables. They know the geopolitical picture. They know the Chinese demand that is waiting to return. They know the delivery window that is tightening. They know the vault inventory numbers. They built the suppression campaign this week specifically because they understood that this precise convergence of pressures was approaching and they needed to reset the technical picture before it arrived. They failed. Silver closed at 84 to 152s. The chart did not reset to a weaker technical picture. It closed at a level that has now confirmed the breakout above every resistance ceiling that the mainstream analysis community had been defending as definitive for months. The $80 level that was supposed to contain this rally, gone. The $82 ceiling that analysts were publishing as the next serious resistance, gone. The $84 level that would have been described as an aggressive bull case target just 2 weeks ago. That is now the Friday closing price. The paper algorithms thought they were in charge this morning. The physical buyers proved them wrong with a margin so decisive that the close itself became the message. 77.39 was the low. $84.52 is the close. That is the tape. That is what actually happened. And what it tells every serious participant in this market is that the structural shift that many have been anticipating has not merely begun. It has already occurred. It confirmed itself today in real time, and it is now in the process of teaching the entities that missed it exactly what it costs to be wrong in a market built on finite physical supply when the physical buyers decide they are done waiting for a better price. Now consider what the opening picture looks like on Monday morning through the eyes of any institution currently holding a significant naked short position in silver or gold. Chinese markets reopen with a week of accumulated demand, a geopolitical picture that has deteriorated materially over the weekend, and a silver price that closed $4 above where their suppression operation fired. Their short position has not gotten smaller over the weekend. It has gotten more expensive with every hour that passed. And the market they are reopening into is not the technically weakened, sentiment-damaged market they were trying to engineer. It is a market that just printed a 7.77% single-session gain on the day they threw everything at it. Gold at $515.90 is not a ceiling. It is a confirmed floor for the new pricing regime. The $500 level that mainstream technical analysis spent weeks defending as impenetrable resistance has been closed above on a Friday. That is not a test. That is a statement. Institutional money does not gap through published resistance levels on a Friday afternoon close unless the decision-making behind that move is based on something far more urgent than short-term momentum trading. The sovereign wealth funds that move today are not going to reverse that decision over the weekend because of a new cycle. The central bank reserve desks that shifted allocation weight into physical today are not going to unwind that on Monday morning. The industrial procurement managers who treated $79.80 silver as a clearance event are not going to return that metal to the vault. What moved today stays moved. And what arrives Monday morning is additive to what already moved today. Every section of this analysis connects to a single conclusion. The trap was set this morning by entities who understood the weapons available to them and deployed them with precision. The Supreme Court ruling was real. The algorithmic response was real. The manufactured slam to 77.39 was real. What was not real was the assumption that the physical market would cooperate with the narrative those entities needed the chart to tell. It did not cooperate. It reversed. It closed at 84.52. And the entities that built the trap are now sitting inside it with a weekend they cannot trade through, a Chinese market returning Monday with a week of unexecuted demand, a delivery window tightening by the day, and a gold price that just told every risk manager on the planet exactly what this moment is worth. The physical buyers won today, and Monday has not even opened yet.